We know that you're not responsible for the fund manager survey, but you do help to understand and interpret it for the clients that you advise that oversee something like $3.8 trillion in client balances. So not a small pool of cash. How do you have the conviction to be bullish at a time where there are so many people who feel like this is getting narrower and narrower, with the most crowded trade being the Magnificent Seven?
Well, thanks for having me. Of course, we want to see this market broaden out. And there's reason to think that the market may feel choppy over the summer, especially as we enter election season and the Fed is battling this last mile of inflation that's giving them a bit of a headache. But when I think about the ingredients for the overall bull trend to continue, we have a lot of liquidity in markets. Financial conditions are easy. We have a solid earnings backdrop that we think will broaden. If you look at this market, so far the S&P year to date has been driven by earnings, not multiple expansion. So that gives me confidence. Also, we're seeing bond yields. I think they'll stay pretty range bound, but they've been making lower lows and lower highs. I think that's a positive for equity markets. And then finally, we can't discount the innovation that's pervasive in the economy right now around artificial intelligence. So I think the bull trend continues. It may feel choppy. We may get a pause here in these early summer months. And what we've been saying to clients is this bull may turn into a buffalo and start to roam a little more, but I think the uptrend is intact.
Well, whether it's a bull, whether it's a buffalo, whether it's a cow, Marci, what we see is an air of uncertainty, and that's what we were talking about with Patrick Harker. This issue that Fed officials themselves don't know how to read what animal that we're looking at. And so it raises this question of where do investors get the conviction that they understand at a time where people are still debating whether 10-year Treasury yields, as we had earlier from Lara Rehm, of FS Investments, going to 5%, or are they going to 3.5%, like what we heard from HSBC's Stephen Major? Marci, how important is that to you, given the bifurcated calls that we're hearing all across Wall Street?
Well, in the near term, I think the path of least resistance for rates is probably lower. But when I take a step back and look at the economy, our view is that the economy is moderating, but very slowly. And I think that'll be music to the Fed's ears. If you see, we've seen pockets of the economy like, retail sales, like housing, like manufacturing data showing some slowing. And then we have a really strong labor market that I think under the hood is normalizing a bit. But it's still pretty strong, giving a tailwind to the consumer. The bottom line with the economy, though, is it's hard for me to get overly bearish when there's so much fiscal support that's creating quite a cushion for this economy. So while I think the economy is going to moderate slowly, it's going to allow inflation to start to trend lower. But I think at the end of the day, we may have a higher resting heartbeat for inflation for some time. So inflation that stays somewhere above 2%. But a Fed ultimately that gets the confidence to cut this year, the Bank of America view is one cut in December. I do think there is a risk based on data that, that could be two. But ultimately, I think you're going to have a Fed that keeps telling us to be patient. They need a couple more inflation prints before they gain the confidence to cut. But when the Fed's data dependent, the market hangs on every data point. Once we get into the next earnings season, though, I think the confidence will come back to investors with this bull market trend to continue.